All right. Everybody good? A lot of lunch, a lot of networking, a lot of chatting, a lot of resting, and now we're all back. And I got to say that after each break, it gets better, the group that just comes back. Everybody gets back, so this is great. Hey, this is a great panel. We're going to be talking with some investment funds here. John's going to be leading a discussion with this group. Again, as we said before, you'll see a lot of the themes get revisited. But again, the perspectives these folks are bringing to it are very different. And so it'll be really interesting to hear how what their take is on a lot of the topics and themes we've hit on with other panels. All right, with that, John, over to you.
Great.
All right.
Thank you, sir. Appreciate it. Bart, right? Appreciate it. Pierre. Oh, that's part of it. Yeah. All right. Hey, John Boitnott here, longtime journalist in San Francisco, as well as content creator for different companies. So talk to me later if you're interested in anything related to content creation or marketing for your company. Okay. So my little thing for myself there. All right. Now let's do a thing for all four of you guys. So take about 30 seconds to a minute and just sort of go in order, and starting with you, Shuo, and talk about yourself, what you do, where you're at, etc.
Sounds good. Hey everyone, my name is Shuo. I am a general partner at Agile VC. We're mainly focused on early stage enterprise solutions, which is a little bit different. But to give you a little bit more background on my relationship with the whole blockchain crypto world, I started my career as a fintech entrepreneur and actually got involved into the conversation around crypto in the very early days. My business partner had always had a deep history with math and machine learning, and so he first learned about Bitcoin towards essentially end of 2009, early 2010, when it was really in the early days. And he was like, you know, I don't know where this is going to go, but anything for math. And so he started investing in Bitcoin all the way back then. And I got involved in conversations there. And our startup eventually got acqui-hired, and I was with Goldman Sachs for many years. And I was involved in a lot of the enterprise layer conversations that we had around what blockchain could do potentially for us as a firm. And since about 3 years ago, my business partner and I started our fund now, again, focused on enterprise. But obviously, if there is a startup that works on leveraging blockchain tech to build a great enterprise solution, that is something that we look at. So happy to talk more about that later. Thanks.
Thank you. My name is Bart Stevens. I'm one of the co-founders and managing partner at Blockchain Capital. Blockchain Capital has been financing startups in the blockchain and crypto ecosystem for over 5 years. We've raised and deployed 4 venture funds. We have a portfolio of 77 companies. We touch over 100 companies in the blockchain and crypto ecosystem, either through our advisory relationships or people that are on our advisory board or CEOs of crypto companies that are actually limited partners in our fund. And so we've reviewed over 3,500 deals in the last 5 years. So we've seen the good and the bad and the ugly in crypto, and I'm happy to talk a little bit later on in the panel.
Hi, I'm Jalak Jobanputra, founder of Future Perfect Ventures. We launched in 2014 to invest in decentralization. Blockchain was obviously a big part of the thesis. We have 30 portfolio companies in our fund. We're based in New York and currently investing out of our second fund.
Good afternoon. My name is Mark Hamadi. I'm a partner of Verus Capital. And really, I believe basically planet, profit, people. I look at creating jobs, and that's kind of how I look at it. I looked into the blockchain for the simple fact of I wanted to get rid of child trafficking and sex slavery. That's a $100 billion industry. So I thought that was a way that can be done. And I have a little Maltese dog that I love, and I got him a lot of Bitcoin and set him up for life because he's the only one that loves me unconditionally for nothing. And my fund, we've done a deal that was $4.2 billion. We've done 25 deals between 30 to 60%. And I got into venture fund because when I operated 5 bankrupt companies and I enjoyed it, I liked that. So they said, well, if you want to work with different companies, do a fund. So I tried that, and so far it's worked. That's it.
Okay, great. Nice to hear about your Maltese. Let's actually, okay, so let's dive in just a little bit deeper rather, and start with you, Mark, about sort of, you were kind of getting into it there for a second with the human trafficking subject and everything, sort of your ethos around the current state of investing in tokenized assets and crypto right now. So let's just sort of go through the 4 of you and talk about sort of your current outlook on it and sort of your personal ethos and in how you determine which companies to invest in, et cetera.
I mostly fall in love with people instead of the tokens or so forth, but I look at value creation. Is there something behind the token? And if there is, then I'm interested. But that's really kind of, it's all about value creation, and that takes work.
Jalek?
Yeah, we are actually very thesis-driven. So with the first fund, when I went to my first Bitcoin conference in 2013, I got the same feeling I got when I started investing in the internet, which was in 1995. And I very much look at the evolution of new technologies and kind of the building blocks that need to be in place before you can have widespread adoption. And so, very much like, we couldn't have Uber and Airbnb without mobile broadband and a certain amount of adoption around mobile technology. And so I view us in the very, very early stages of blockchain tech. And so the first fund, we focused on a lot of infrastructure build out in companies like Blockstream, Blockchain, Abra, and then as well as emerging market applications like BitPesa, where I was born in Nairobi. I've spent half of my life in the emerging markets, and that's where I actually see a lot of the new business models evolving from this technology. However, I mean, we still, I think the ICO boom kind of set us behind a little bit in some of the infrastructure build out because there was a lot of capital going to companies that probably shouldn't have gotten that capital. This year has been a lot of recalibration, which I think is good to see, where we're returning to building and teams understand that a lot of this is longer term build out. So infrastructure, middleware are both areas we're very interested in, and I'd say applications and some of the emerging markets.
This is, Jalak and I have been on probably dozens of panels together over the last 5 years, so it's a pleasure to be up here with you again. I often get asked about what's going on in crypto in 2018, and I have to just remind people that it's pretty simple. 2017 was like a raging party. It was awesome. Everything went up like 2 to 100x, and 2018 is the hangover. That's what's going on here. You can't have asset class go up 20x, 30x in the case of Ethereum and Bitcoin and not have some sort of retracement. It's just the nature of cycles. It's psychology. It's the nature of capital formation and speculation. And so it's a challenging time if you're an entrepreneur right now. It's a challenging time if you're an investor, primarily due to acute regulatory uncertainty. What we saw last year was that Ethereum's ERC20 standard really captured the imagination of both investors and entrepreneurs worldwide. With 2 lines of code, you could create your own crypto asset, whether that be a utility token or a security token, and there's real questions on whether that category utility token even exists in the mind of the SEC. So, and we saw $18 billion of capital being raised, kind of Kickstarter on steroids. That was an incredibly exciting development. To me, it proved Ethereum as a platform for, at a minimum, global crowdsourcing, where entrepreneurs can go and not go up and down Sand Hill Road and raise capital from the traditional venture capitalists, but rather to offer an incentive for other entrepreneurs and protocol developers, engineers, open source software developers to hopefully build on top of your blockchain. So the concept is to turn your customers into evangelists because they have they're stakeholders in a given crypto network. It was a very exciting time, and now what we see is profound regulatory uncertainty. The SEC has told the industry what they can't do, and I'd like to delineate between the SEC going after fraud and bad actors. That is important. There's fraud in the stock market. There's fraud in the bond market. There's fraud in the regular currency market, the fiat currency market, and there's fraud in the crypto market as well. It's important for the SEC to go after all that stuff, especially at the birth of a brand new industry like blockchain technology and crypto. But what we're seeing is there's essentially no path forward. So if you're a token issuer, if you're an entrepreneur and you want to do an ICO, the best law firms are essentially saying you have to avoid the US. You have to avoid the US people, you have to avoid US customers, you have to avoid US developers even. So if your developers are in the US, so basically if you touch the US in any way, it's a contagion, and it can basically turn you into a security, whether or not your token you believe to be a utility token. So we're at an important time. from a regulatory point of view, and that's, in my view, that's the primary, besides kind of market cycles, the other major effect that's going on in terms of capital formation and entrepreneurs, at least here in the US, is there's essentially no path forward for a lot of entrepreneurs, so it's a frustrating environment for investors and entrepreneurs alike.
So I think Bart already gave a wonderful overview of where the industry stands. So I'll try to add on to it from a slightly different perspective. I think obviously there's been an explosion of capital and a lot of entrepreneurs coming into the blockchain space. But I think the benefit of what happened last year was that it pushed a lot more kind of traditional players faster along than they otherwise would have been. So at least when I was at Goldman, we started looking into this space really as early as kind of 2011, 2012. But those conversations weren't very serious. It was just like, this is something that's coming. Let's explore this space. I've never practiced law, but I have a JD. And so while I was at Goldman, I had a lot of contacts from the SEC that I would regularly catch up with and have conversations on. And back then, it wasn't really called blockchain. I had a lot of international clients I was covering and was traveling a lot. So as early as kind of 2010, the New York Stock Exchange, Hong Kong Stock Exchange, and Australia Stock Exchange already had an internal project that they were prototyping using decentralized ledger to help them better identify for insider trading. So it wasn't a completely new concept. But there wasn't much progress made in this space at all until last year. Everybody was talking about it, and a lot more nonprofits, organizations, think tanks were formed. And I think that really pushed a lot more traditional corporates and players faster along. And I think that also helped encourage a lot more corporate and startup partnerships that we didn't see as much before in other industries, which I think is a really healthy way forward. And outside of that, I think what Bart mentioned about, as well as what Jalak mentioned about emerging economies is really interesting. Because of the regulatory environment that's now in the US, I think I've seen a lot more innovation emerging from other countries around the world, whereas I think traditionally Silicon Valley, we don't see nearly as much international influence, whereas in the blockchain space, I think for the very first time, we see a lot of Chinese influence, we see a lot of Korean influence, a lot of Japanese influence, and I think that's particularly interesting. I actually just got back from a trip abroad where I was in India for a teaching engagement, and I see a lot more initiatives from a government perspective, from very traditional corporates. I was actually teaching for a company that's now well over 100 years old in India in a very traditional retail space. And for the very first time, they're actually opening up conversations with the government to explore what they can do, how they can adopt blockchain tech to help them better facilitate their manufacturing process. And so I think there's been a lot more of these conversations coming along that is actually quite healthy for the industry as a whole. So if we're looking beyond how much capital has been flowing into the industry, if we look beyond regulatory changes, I think fundamentally speaking, there's been a lot more value add.
Great. Let's talk about regulatory changes in the next several months, 2 years. We'll start with you and just go back in the other direction. What are some of the ways that regulation is going to be applied, and what effect do you think or do you hope it might have?
So I think for the U.S., it's very hard to speak on behalf of the SEC to forecast what they might or might not
crystal
do.
Ball.
But let me start with international markets. What has been interesting was that, well, obviously it was really big news when China first banned the whole concept of ICOs. But actually, it was around that same month when we actually hosted a delegation from the central government in China here in Silicon Valley when they were visiting, just when that news was first coming out. And I think what they shared then still remains to be true nowadays, where they said, really, it has to do with a couple of fundamental principles that they were approaching that regulatory change. One is, I'll start with something that's different about China as opposed to any other market in the world. As a state policy, they really want controls over inflow and outflow of capital. And that's different than the US. I don't think we worry here in the US as much about capital outflow controls. And so they want to be able to see where that capital is flowing to. Right now, obviously, Chinese citizens have limitations as to how much capital they are allowed to send abroad. And previously, through crypto channels, essentially, you could send money abroad without government regulation. So that's a fundamental difference to what we're looking at here. But otherwise, for for them, it's a very simple question of fraud. I think for a lot of ICOs in China, you see unprecedented cases of fraud that we just simply don't see here in the US. Obviously, that's starting to change, but a lot of the cases, if you guys are interested, we can talk about how there's been a lot of ICOs that are raised in very creative ways that actually kind of skirt aside regulation and controls and information disclosure. But that aside, I think as a result of that ban, one positive and one negative outcome. The positive outcome, I think, has been that if it weren't for that ban, I think the industry or even the crypto markets as a whole may potentially have crashed earlier just because of a lack of confidence around regulation and guidance and information disclosure. I think the kind of potential negative is that it's actually directing a flow of talent into specific markets around the world that are more open to that. For example, one of the partners that we worked very closely with in the past couple years used to own the largest Bitcoin mine in the world. He was based in China, but he moved out here into Silicon Valley and has been living here for the past year. And so we definitely see a lot more entrepreneurs flowing into Silicon Valley. And I think outside of the flow of talent, I'm sure other panelists will share more about flow of capital as well, so I'll stop there.
Those are great comments. And I think it's really important to situate this industry in a global context. Some of the largest market cap companies and projects actually happen to be based in San Francisco, whether you're talking about companies like Coinbase or Ripple or others, or Kraken. You can go CoinList, on and on. There's some folks here from the audience. So there's a tremendous amount of innovation happening here, but I think it's incredibly important for investors and entrepreneurs and especially regulators to realize this is a global phenomenon. The markets of China and Korea and Japan that you mentioned are incredibly important. From a regulatory point of view, the US is effectively offshoring innovation. They're saying the US is closed for business. Go to Malta, go to Singapore, go to Switzerland. A week ago, I sat at a conference with President Clinton speaking, and he talked about, I think, some important kind of stories or anecdotes when he was president of the United States during the 90s. And he basically said that we took a hands-off approach. We wanted to let innovation flourish before coming down with too hard of a regulatory hand. And so federal regulatory entities like the Federal Trade Commission, the Federal Communication Commission, even the IRS said no sales tax on your Amazon order. And so as a result, both entrepreneurs and providers of capital, venture capitalists, they kind of knew the rules of the road. And when you know the rules of the road, the magic of US capitalism can happen, which is the efficient allocation of capital to the world's most promising entrepreneurs. That is no longer happening here. I think the crypto industry has been dangerously naive over the last 3 years. They've assumed that many US regulators have this kind of balanced approach to innovation on one side and consumer protection on the other. And things have changed markedly in the last 6 months. There are hundreds of subpoenas out in the crypto industry right now. This is not well known. Whether there are exchanges or law firms or investors in ICOs, startup companies, as little as 3 people. And so as a result, what we're seeing is capital formation is freezing because both investors and entrepreneurs, they don't know the rules of the road. They know what they can't do. You can't steal, you can't cheat, you can't lie. But it's very unclear on how, for example, a protocol would conduct a public sale of a utility token to US investors. So there's kind of no guidance from appropriate regulatory authorities on that. And so, there's the risk here is that the scales, the balance between fostering innovation, which is incredibly important for our economy to create jobs and tax revenue and GDP growth, and also protecting investors on the one side. I would argue that this is not the fault of the SEC per se. They are applying the laws that are on the books. The laws that are on the books were written in 1933, 1934, and 1940. So I would argue that crypto assets are a new asset class, and they are ill-equipped to be dealt with security laws that are getting close to almost 100 years old. And so it's a problem in the industry, and it's an important one. And it's hard to look out 2 or 3 years because right now I would say things are getting worse, at least for US investors and entrepreneurs, not better.
So where I have a question for you. Where do you think the regulation, other than like small jurisdictions like in the Caribbean or Malta, are there any major economies where you think we should follow?
Singapore and Switzerland for sure.
What are they doing that's different in terms of protecting investors or what have you?
Yeah, they're giving clear rules to the road. They're saying, if you do X, Y, and Z, then you are a non-security token. And here's the regulatory regime that you need to do in order to sell your tokens in an ICO process to residents of Switzerland versus rest of world. We don't have that from our regulatory authorities, namely the SEC. But by the way, there are 9 regulators that claim jurisdiction over crypto. The Department of Justice is involved, Department of Treasury is involved, Federal Reserve, SEC, CFTC, IRS, FINRA, and that's not even including the state regulators like the New York Attorney General under the Wells Act have sweeping powers in the financial services industry. So if you're 2 kids out of Stanford and an awesome protocol idea or utility token, good luck, navigating through those 9 regulators, not including the states where money transmission laws are different in all 50 states. So I guess what I'm saying is we need to take a holistic approach to fostering innovation that recognizes that this is a new decentralized technology. This genie's out of the bottle, it's global. And also perhaps writing new legislation that is better crafted and that's not 80, 90 years old. That would be my recommendation. And to provide a safe harbor for entrepreneurs that are really trying to innovate, that are trying to create new things.
So that's my issue. If you look at Asia, it's business first, regulation second. We're regulation and then business second. But where's the regulation, right? Where's the regulation? So we're letting innovation die and go out, and that's the sad.
I really feel like I'm in the middle of Silicon Valley now. I mean, I lived here. I've lived here many times before, but my view is what we're seeing is an effect of the industry's inability to self-regulate last year. And I'm not like for, I'd say I'm more libertarian than not, but we saw a ton of fraud last year. I mean, there was no way you could justify just issuing, tokens that were obviously meant for fundraising purposes with no utility under the guise of, the current securities regulations. So, and I had cautioned entrepreneurs because, look, I believe in tokenization. I want to see this industry take off. I want to see people have access to assets they haven't had access to before. I want to see broader distribution of upside. That's why I got into this industry. But what we saw last year was just widespread fraud, and the crypto industry didn't do anything to self-regulate until this year when these subpoenas started getting issued. And so I think we went to the other extreme, and that's unfortunate. And I actually, I travel around the world, talking to regulators, including in Switzerland, including India, including China, Singapore, and at the end of the day, a lot of them are still looking at what the U.S. is going to do. And so I agree that we need to have more clarity. And I think this kind of utility token, new asset class is something that we do need to address at some point very soon. And I actually do think we're making some movements there. The reality is the U.S. has a lot more to lose versus some of these other jurisdictions we're talking about. And China banned in quotes. India has made it very difficult to bank exchanges. Trading there is down. So we've seen harsher regulations in a lot of these places, and so. Yeah, I think it's up to us as an industry to make sure that we start to see, and we have to get engaged. And we didn't have engagement last year, and hopefully we'll start to see more of that going forward.
Mark, your thoughts on where regulation might or might not be headed in the next several months to years here?
Well, I mean, I agree that there was too much fraud, right? I mean, there was a guy actually who went and got Chuck E. Cheese coins, put Bitcoin on it, and got $2.8 million. and people paid him that. So, I mean, it's ridiculous. But I think on one end, banking is this way, crypto's on this end. We got to meet halfway. Okay, we got to meet halfway.
What does that look like? What does that look like?
Well, it looks,
potentially?
I mean, look, I don't think ICOs are bad. I think the companies they funded were bad. And that's the issue. So it's really looking at the white paper, looking at that technology, and seeing, is it going to go somewhere? And then protecting investors by telling them, okay, hey, this is something. Let's do something. So, and that's, we do that for regular investments. So we need to do that for, blockchain and crypto, because we can create a lot of jobs. There's a lot of great things that can happen with this industry. That's the exciting part. So we have to push the regulators, really. But, the government is slow, unfortunately.
So obviously, you're still bullish on blockchain. I know that. Why?
Well, I'm bullish on great people. If you have great people, they create great things. And, it's proof of concept. Are you, like I had cancer, right? And how did I get rid of cancer? I got rid of my pain. There's a pain in different industries, and blockchain can help solve that pain. And that's what's exciting about it.
Any other thoughts from you guys on blockchain? Why that's something that's going to last?
We see, I'd say 90% of the 200 plus business plans that come into our office a month, blockchain is not a good application for the startup or the customer problem they're trying to solve. Blockchains are essentially a new data architecture. It's a distributed and decentralized database where data is replicated over hundreds, thousands, sometimes hundreds of thousands of nodes. That is costly. It's inefficient. And so you need blockchain technology if you are trying to ensure that there's not tampering with a given data set or a given value transfer. And so Bitcoin has got a proven use case for kind of a gold 2.0. Some people see it more as PayPal 2.0, and that was kind of the guts of the Bitcoin Cash versus Bitcoin hard fork. And Ethereum has proved itself, I think, as Kickstarter 2.0 or maybe NASDAQ 2.0. A lot of these other blockchains are building interesting technology, whether it's EOS or Telegram or Dfinity or others. But what we haven't seen is a lot of these things live and in the wild yet. What we haven't seen is their organic, unmet demand on the customer side. So because blockchains are expensive and because the data set is redundant and replicated, you have to have a good reason for having tamper resistance. And so you really need to ask yourself, if you're an entrepreneur, does an Oracle database work okay? Because if so, you should go with the Oracle database. It's much cheaper. If the answer is no, because you need to ensure the veracity of a data set or a transaction or title transfer, for example, in an untrusted environment, then blockchains are probably a good solution for you. But just kind of tacking blockchain onto your business plan generally won't get you an investment from sophisticated investors that have domain expertise. I think those days are long gone. And we remain excited about tokenized technology. We actually tokenized our third venture fund. We did an ICO. We raised $10 million in our third venture fund. We took something that was previously illiquid, that is a private equity fund, and we made it liquid by fractionalizing it and tokenizing it. We created the world's first security token. It's called the BCAP. And so that was an example of tokenized technology allowing for something new to be created, which is we brought liquidity to a previously illiquid asset class, private equity. Companies like Securitize and Harbor are looking at doing the same for the traditionally illiquid asset class of real estate, which is the largest single asset class in the world. So if this technology, if you're an entrepreneur in this technology, whether it's blockchain technology or thinking about an ICO or creating a token, if it is enabling you to do something that the world has never seen before, you're probably in the right spot. If a regular database will do just fine for whatever you're thinking of and you're just adding a token for fundraising, you're very likely introducing friction into the customer experience. We call this a friction token. So if you're making someone buy a token just to get to your product or service, and there's not a good reason for it to be decentralized, or it's not operating in an untrusted environment, you very likely have a friction token. And friction tokens, I think, are a real tough experience for users. We don't have to go out and buy Starbucks dollars to buy our Starbucks. We don't have to go buy DocuSign tokens, we're speaking here in the DocuSign office, to use the DocuSign service. If that is the assumption that you're making, that users are going to have hundreds of tokens to do different services that work just fine, like DocuSign or buying coffee, you're probably barking up the wrong tree as an entrepreneur. So these are good questions to kind of ask yourself.
And I think so far we've had a lot of really great perspectives on tokens, and I think it's just important to also realize the fact that we could completely not talk about tokens as well, because there's plenty of applications that are being built or infrastructure platforms that are being built that don't necessarily have tokens involved. And I think that perspective is important because oftentimes we only think about the application layer, but we forget the fact that this is a very new industry. If we're looking at AI, for example, the algorithms that people are still using now, albeit with better compute and better data, they've been around for decades, right? They've been around for 60 years. But the thing is, with blockchain, it's a very new piece of technology. So the developers' environment that they're working in right now is still actually very new. So for a new crypto or just pure blockchain company to want to start a project, they don't necessarily have all the infrastructure in place that makes it as easy for us to, say, build another mobile application or build another website. And so I think from a purely infrastructure standpoint, especially since we look a lot at enterprise solutions, I think that aspect of it is quite interesting. Instead of B2C, what are some of the interesting B2B opportunities that are available in this space?
Jalek, anything?
Sure. Yeah, I mean, we look at, as I said, we're mainly looking at infrastructure and middleware right now. I actually started my investment career in '99 out here for Intel, investing in middleware. And so I think until we get some of these rails built, we're not going to see widespread consumer applications. Now, I think there's some great experiments happening right now around consumer, but I mean, if you look at what Google just announced today, that there is this major data breach. They're shutting down Google+. And they kept it from their consumers and those affected for many months. And, you know, these Web 2.0 companies have accumulated so much power that I'd say the average person is kind of doesn't care anymore how their data is being used. And so that is actually one of the most, I think, you know, that consumer adoption is going to take some time unless we come up with some applications that may not be as focused on privacy or other things, or create a vastly better consumer experience than what exists right now with our interactions. Now, if you start to look at emerging markets who don't, I mean, 2 billion people who don't have banking accounts, billions without any health insurance or car insurance, they're starting from zero. And so that's some of the places where I think we'll start to see some of these consumer applications emerge. Just like, so I invested in telemedicine in Africa and India about 10 years ago. We are just starting to see telemedicine take off here in the United States. And so I think we're going to see some of that reverse innovation happening on the consumer side. On the enterprise side, I'm actually seeing some really interesting, like KYC, these pain points, fraud detection, that's making some of these industries start to look at alternative technologies or what blockchain can offer.
I think, just to chime in real quick, I think Jalek makes some great points about data breaches and privacy, and it's important to kind of rewind the clock back 10 years. Why did Satoshi Nakamoto create Bitcoin and blockchain technology? Well, because in 2008, the global financial system as we know it failed us in a galactic way. We had trillions of dollars of bailouts. We've had $15 trillion of money printing. And that is a result of the interconnectedness and over-leveredness of existing financial incumbents. Satoshi, him, her, or they, was disgusted by that. They said, what if we could create a system where you don't have to trust a center counterparty to execute a transactions? What if you could basically put in a proof of work system that aligned people's incentives in an elegant way to form a consensus that would allow the transfer of value between two entities or two individuals? That was a profound idea. I still am in love with it. But it was essentially a reaction, right? It was the 2008 financial crisis showed us the incumbents were incapable of protecting the system that they had created. They had gotten too over-levered. They had gotten too interconnected. I think we could see a similar reaction to the types of things that Jalak mentions, which is if you're using Facebook and Instagram and Google and you think their products are cool and you haven't paid them, means your privacy is the product. They are selling that to advertisers, targeted advertisers. Now we find out that the Russians and Chinese also have your data. And so I think we could see a similar moment at some period of time where blockchain technology is potentially an answer to the large centralized internet monopolies that dominate our life online: Amazon, Apple, Facebook, Google. I think this is a ways out, but decentralized approaches to centralized trust problems are the promise of blockchain technology. But these are hard problems to solve. Incumbents don't go away easily. That's why Jamie Dimon really hates Bitcoin. He sees it ultimately as an existential threat to his business. And it's why we're seeing deafening silence out of Google and Facebook in terms of blockchain technology. If you have a monopoly, you just be quiet and cash the checks. It's a great business. You don't want to rock the boat, man. And so a lot of these technologies, whether we're talking about ICO technology or blockchain technology, they're incredibly disruptive. And they're disruptive to the status quo. So the maintainers of the status quo are going to fight like hell to keep their advantages.
Shuo, thoughts?
So I absolutely agree with that. A slightly different perspective. So outside of my investing role, I've been teaching at Berkeley for the past couple years, and so I teach both undergrad as well as graduate classes. And for the undergrads I'm teaching, it still blows my mind that kids now are born after the year 2000, and so that I would have thought they're babies, but now they're in college and taking classes. And whenever I chat with them, I realize that they have a very different value system. I think for us, it's very disruptive, the fact that blockchain companies could potentially rock the boat and change this whole economy around that's really focused around monetizing your privacy. But when I talk to kids now, I don't think they grew up with the whole concept of being concerned about privacy fundamentally, because they grew up being so used to giving away data that they're very willing to trade away data for access to these products and services. And so to that extent, I don't know to what extent blockchain tech could really change the whole concept of being able to monetize data and privacy fundamentally. But I think what is interesting is that, especially at Berkeley, it's always been very much a hippie culture, and people are very anti-institutions and anti-establishment. I think from that perspective, they are very interested in terms of what does it mean if we have more power, if we can distribute democracy more equitably, and if we can distribute wealth more equitably. So I really like some of our conversation earlier about the potential for blockchain to really make an impact in terms of creating social value, in terms of thinking about how can we better distribute services and information in a way that's beneficial to refugees, for example. The United Nations has been collecting donations in Bitcoin in certain economies around the world where locally they're experiencing hyperinflation, and so they just store their value in cryptocurrencies like Bitcoin until they actually need to distribute and also save money in the transfer of this capital. Rather than going through banking institutions, they're just going through crypto, which is cheaper in fees. So I think a lot of those opportunities are really interesting as well. But really coming back to applications and infrastructure again, I really like what Jalak was saying about infrastructure and middleware, because I think that's where it's really going to first start.
Mark, any thoughts on?
I'll just agree more with Bart on the sense that I think millennials do, they'll appreciate once your privacy is stolen, then you really appreciate it. But until it's stolen...
Will the blockchain come and save us from losing our privacy 7-8 years from now?
Yeah, I mean, it can. It definitely can. And I think like with Facebook and Google and what's going on, I mean, it's pretty bad. I've had mine.
Yeah, will we have any privacy left to lose at that point?
I don't know, but it's pretty bad. I mean, when your credit cards are taken and your identity and so forth, until you've gone through it, it's a horrible feeling.
By the way, I agree with you. I would absolutely feel the same way. I'm just surprised by what I hear from students nowadays who don't seem to share that same concern as me. And I don't know if that's just the groups of students that I've been teaching or if that's more of a widespread phenomenon. But
because they haven't experienced it, they haven't had assets to lose. They haven't had,
when you're stuck in a different country with nothing, your phone isn't going, somebody else has it, you have zero money, when you thought you had money, and you're really borrowing money on the street to make a phone call, and you don't know the language, it's pretty difficult.
All right, let's move on to, no, that's good, valid points. Let's move on to questions from the audience. I know you guys probably have had a chance to think of a few, or you have some thoughts. And so for the remainder of the time, let's mostly do that. Let's take some questions from the audience. Go for it, Jason.
I was just wondering, I know everyone's talking about, and thanks, Joel, for bringing this up, but middleware and, sorry, everyone, I'm pretty loud anyway. But talking about middleware and really building these protocols from the ground up, but they're useless unless people are actually using them. And there's a lot of developer activity, which is really exciting. I'm wondering, with all of the amazing deal flow that you've seen, have you seen some really killer apps that we don't know about that have some consumers using them and then thus using this middleware that you've invested in?
That's a great point. It's an astute observation. We've seen a lot of development entrepreneurial for solving problems that don't yet exist. So they're saying, let's build a 3.0, let's just call it a 4.0 blockchain that will do 2 trillion transactions per second. There's no demand environment for that right now. I'm unaware of any large-scale enterprises that have a decentralized application that is working in production. And so if you're some of these enterprise-focused blockchains and your main metric is transactions per second, you are building kind of a 80-story skyscraper to house all your employees, and you're like a one-person startup. So it's great to have grand plans, but maybe that's not a wise expenditure of capital. You might want to just go to WeWork for a couple years and see how it goes. So one of the areas that we are seeing organic demand and some interesting startup activity and end user activity is the intersection of video games and crypto. Non-fungible tokens. So we have an investment in a company called OpenSea. It's kind of a marketplace for digital assets or video game assets. It's interesting. So if you play a video game like World of Warcraft or Second Life, there are tens of millions, and if you want to include Asia, over 100 million users that basically play or live in these virtual worlds. And these virtual worlds have virtual economies, and the economies have virtual currencies. And you can have digital objects. But at the end of the day, until about this year, all those objects weren't owned by you. You might have spent like, a year of your life getting some super special fire sword, but it turns out that in World of Warcraft, you don't own that fire sword. Blizzard Entertainment, owned by Activision, a publicly traded company, owns that fire sword. So if you go try to sell it for US dollars, you are out of luck as a gamer. That is changing now. Persistent worlds, even casual video games where you can earn something in-game by slaying a dragon and you get a magical coat of armor, you can actually pull that out of the game, go to OpenSea, and sell it for Bitcoin. You can go to Coinbase and sell your Bitcoin for US dollars. So as a lifelong gamer, that's incredibly interesting. It's also worth noting that crypto is, unfortunately, but the data proves this out, overwhelmingly male-dominated, and it's a young person's asset class. It's primarily of interest to people in the 18 to 35-year-old demographic. There's a few people in their 40s like myself that own a bunch, but that happens to be the same exact demographic as video gamers. So there's like a one-to-one demographic crossover between video games and crypto. So CryptoKitties was the first example of that. I think there'll be many more games that capture this notion of video game players owning the experience, owning the work product, or the results of some endeavor online. So that is an area where we're actually seeing organic demand environment, unlike some of the other areas that are still early stage, whether it's enterprise adoption. Those are still, for the most part, still at kind of proof of concept type stages.
So out of our pipeline, I'd say at least half of it involves the gaming industry. So, and it's very similar to what we saw with mobile and the internet in terms of adoption. I also think as we look at scalability issues, right, and going back to infrastructure and middleware, I think it could be gaming that actually leads the charge in terms of solving some of these challenges that are kind of inherent in the more generalized protocols that we see out there. So I'm looking at protocol, middleware, as well as application within the gaming blockchain space right now. But otherwise, I have to go back to financial services and emerging markets, right? An example is BitPesa. They've seen a lot of growth just handling that FX transaction using the Bitcoin blockchain platform. And they're now primarily B2B versus starting off on the consumer remittance side, because even multinationals need to figure out more efficient ways or want more efficient ways to move their capital to places like Africa as these regions start to grow. But other than that, I'm not as much consumer focused. To me, it's really about the infrastructure and making sure that when consumers or enabling developers to create applications that can scale, because if they can't scale, and we've seen this with CryptoKitties, right? Then it's going to go away. And a lot of consumer is very fickle, and so I think you need to have that infrastructure in place to be able to support these consumer applications.
So it's funny what you just said, Jalak, because my question was, I wanted to ask if you also agree that in order to get a customer blockchain solution going, we need to get to a point where the customers don't even realize that they're necessarily using the blockchain, whereas for infrastructure, it's pretty good to be more transparent. So do you think we're going to see a trend where we see a mixture of centralization and decentralization, where the infrastructure and the important data is decentralized, whereas the application management is more centralized for the customers?
Yeah, I think it'll be a long time before we get to completely, decentralized applications. And we're seeing this in finance too, right? There are a ton, I was seeing a decentralized exchange business plan, once a week or twice a week about 6 months ago, and the reality is, people still want to be able to trust a source, and the other flip side is the infrastructure and scalability that we just discussed. So I look at the next 5 years as we're going to live in this at least the next 5 years, we're going to live in a very hybrid world. And, I'm not turned off by applications that are using a mixture of the two, because I think that will get us to that ultimate decentralization, but we can't get there overnight. And if we try to get there too quickly, then I think it bodes, poorly for the adoption down the road. So I think we're going to learn a lot. I'm so excited about the next year. We're going to see a lot of these projects and protocols get to market, see what's working out in the wild. You can only do so much diligence on a white paper, and you got to put it out in the wild. And so this next year is going to prove out a lot, and then and we'll start to see, what that path to fuller decentralization looks like.
Yeah, hi. Just continuing what Jalak and Bart were saying. So scalability still seems like a fundamental issue to solve or to be solved in this space. What do you guys think in the next? How do you evaluate people or projects making traction when you say, hey, we do not need a project doing 100,000 transactions. At the same time, you need developers coming and building applications. So if you were to evaluate scalability projects in the next 6 months, how would you see progress, or how would you define progress?
I think it's important to talk to customers. Be surprised how many entrepreneurs that we meet with that are building technology that they think is really cool. And then, as part of our job in doing due diligence in a prospective investment, we go talk to a bunch of customers. And they said, we don't think that's cool, or we have no need for that, or that's item 20 on my pain point list. Let me tell you what pain point 1 is. It's difficult if you're building a de novo blockchain to jump 5 or 10 years into the future and know what the demand environment is like. But a good way to start is to go talk to your customers. So if you're building a blockchain that is focused on international trade and finance and logistics, go talk to the largest shipping companies in the world. Go talk to the large manufacturers in China and see if they need to track title of goods from all the various people that are involved in their supply chain, right down to the guys at the dock. So that's a good place to start, and it's something that I think a lot of entrepreneurs perhaps don't do enough of in the early days, because you want to vet all of your assumptions before you go spend tens of thousands of man hours on building something that maybe ultimately the customer doesn't really want. And you want to solve people's most acute pain point, whether it's a consumer or an enterprise.
Yeah, and I think going back to the scalability question, it's different use cases are going to have different scalability requirements, and that's what we've looked at in our first set of investments over the last 5 years was, where do we not need to have a huge throughput, and where can we start seeing whether this technology works? And BitPesa was an example of that, right? Where you didn't have to do millions of transactions or thousands of transactions or hundreds of transactions a second. And so it's, as an investor, very much looking at, the other extreme is high frequency trading, right? It's going to be a long time before we get there on the blockchain. So figuring out what different applications and matching it up. And I think we'll continue to see, we have so many smart developers working on these protocols and more coming into the fold. So we'll continue to see massive development on scalability in the next few years.
Jalak mentions a really good point. So even though it's a frustrating environment if you're a U.S. entrepreneur or a U.S. investor on the regulatory front, I'm sure the rest of the panelists are seeing the same thing, but we're seeing an incredible amount of super high quality engineers and entrepreneurs that are kind of leaving their day job to go start a new blockchain infrastructure project or consider a new protocol or to build a relayer on top of 0x or to leave Electronic Arts and start an NFT company. And one of the things you want to see as an investor is not just a large total available market. That's something that all venture capitalists look for. But you really want to see people not just voting with their pocketbook, that's kind of our job, but voting with their feet, taking a career risk. And just to use Coinbase as an example, which is the best known company in the sector, one of the largest and is here in San Francisco, they are recruiting executives from the New York Stock Exchange, from Goldman Sachs, from Salesforce, from Facebook, from LinkedIn. And if you look at companies that are maybe not quite as mature, they are also seeing incredible engineers and operators that are leaving, whether it's Twitter or Foursquare or Dropbox. These are all kind of resumes of founders I've seen just in the last week. And so what you want to see are big ideas, people that can be a part of something that they feel is bigger than themselves, large total available markets, and high-quality people and capital all coming together at the same time. And that's pretty much what's happening in the blockchain technology industry.
And that's an amazing point, because that's where I think regulation is. As soon as the SEC is trying to do some regulation, it's just going so fast. It's going so fast, and things are changing so much. So you can't say, okay, well, this is how it is. Let's regulate this, because it keeps adoption and changing.
Shwo, any thoughts?
So actually, I was going to add on a little bit to Bart's point about really doing the due diligence as an entrepreneur and talking to all of the right people. So I think I've seen a lot of pitches where entrepreneurs are talking about how exciting it is to be able to reduce costs and improve transparency in the shipping industry. And a lot of them like to quote the Maersk IBM essentially trial and to say, well, that managed to be able to save 20% of the shipping costs. But on my last trip in China, I was talking to some of the largest shippers, and they were like, 20% of the shipping costs, I don't give a damn about 20% of the shipping costs. Like, that's not a very big portion of my overall costs, because a lot of the shipping that they do is on specialized products, for example, where their largest margins isn't where it comes to shipping. And so I think those conversations are really important to figure out, whether or not you're a blockchain company, I think it's important to really understand what pain you're actually solving.
Great. Other questions from the audience? All right, here we go.
So if you think at the end of next year, what do you think are going to be the biggest applications that are adopted, and what kind of scale do you think is going to be possible in sort of the next 12 to 18 months?
Well, I guess I'll start with something that's more top level. I think what needs to happen in the next year to year and a half is real business value. I think as a startup, it's really important to think about, do you have a real revenue model? Are you actually saving costs for your customers, or are you improving the experience or making things easier, faster, cheaper for people? I think for a lot of blockchain applications that were started last year, especially given the hype, it was solving for problems that don't necessarily yet exist. And so a lot of the companies don't necessarily have real business models. And so they incentivize a lot of great talent to join by basically saying, well, we're doing an ICO, we'll share tokens with you. And so people had income that way. But now that there's more regulation around tokens, I think there is a little bit of a question mark for certain companies as to, well, where is our stable cash flow going to come from? So I think that's something that people are going to have to work on.
Yeah, some areas that we're pretty excited about in the next year to 2 years would be kind of the decentralized financial services stack. One of the great promises of blockchain technology is to reduce the risk of a counterparty failure. So there's a lot of ironies in the crypto and blockchain industry, and one of them is there's a series of themes or values that pervade the industry. Themes like decentralization, transparency, paying open source software developers, aligning incentives. These are all great big ideas. But in the case of financial services, what we really want to see is, can we build a new decentralized kind of financial stack that allows for decentralized derivatives, decentralized exchanges and relays, because that fulfills the promise and the values of this stuff. What the irony of a bunch of people in a room that are talking about decentralization, then they turn around and they go to centralized exchange to trade their crypto assets, which is a single point of failure. So I think we're going to see a lot of innovation in financial services, just taking a new decentralized approach to things that have traditionally been done in a centralized fashion. I think we'll see, as I mentioned earlier, the kind of intersection of crypto and video games will be a big market. We're also very constructive on security tokens. Security tokens that allow for the fractionalization and tokenization of traditional assets. Right now, if you're a large hedge fund or a family office and you want to trade a credit derivative, you're waiting like 30 days for something to settle, or if you're an investment bank or a money center bank. And so there's still, most of the back office of investment banks and insurance companies is stuck in the 1970s with IBM mainframes. These things are at the end of their natural life. Actually, the end of their natural life was about a decade ago. So there's a really good opportunity to kind of swap in some new infrastructure if some of the hype kind of gets dialed down, if some of the real use cases show a compelling return on investment, not 20% of some line item that they don't care about. That's a great point. And so security tokens, decentralized financial services, NFTs and video games are some of the areas that we actually think are interesting at Blockchain Capital. Scale, I wish. One thing I don't do is predict scaling issues or the price of crypto assets, because it's just impossible to do. I think we are seeing some interesting blockchain kind of middleware solutions, scaling solution coming out of the Ethereum ecosystem. Other kind of 3.0 projects work, EOS and Dfinity, and others that we've looked at that have are taking a scaling first approach, even though there's not the demand environment yet or the number of users. So. This industry moves at a velocity that is really difficult to comprehend. I mean, we have 13 people here in San Francisco that are focused full-time on crypto and blockchain technology, and it is really, really hard to stay up on this industry. It moves very fast.
Yeah, I am very interested in the next year around financial services and really the friction points around, like, I'm a believer in tokenization, as I said, but what are the friction points in making it happen? Compliance is one of them, as much as the industry wishes that didn't exist. That's the reality. So looking at compliance solutions, looking at data analytics around exchanges, and I mean we also invested in Harbor, and so different platforms that allow fractionalization and tokenization, but do it within regulatory frameworks that exist. And I think once we start to see some of that play out, we'll get to a point where we can see more decentralization. I think we have to prove that actually the technology can be used for compliance. I had I was on a panel with Valerie, who heads up, the SEC's crypto program, and one of the things she keeps telling entrepreneurs is like, show us that you can actually use technology to address some of our compliance question marks, and I think that's an important guidance that they're putting out there, that they're open, and that's why I invested in Harbor. I think they're doing exactly that, and there are a number of entrepreneurs who are. So before we can get to like this free trade of tokens around the world, we have to show that we'll work within current regulatory frameworks.
Mark, your turn. Any areas that you're particularly excited about?
I'm excited about everything. I mean, it's the use case and
The entrepreneur.
The use case, and really solving a pain and just showing it, and then the customer needing that pain. And again, if that's done, you're creating jobs, and that's really ultimately what it's about.
We're down to our last couple minutes. Have time for probably one last question. Is there anyone who would like to ask the panel anything? All right, we also hear about tokenized assets, some of the sort of, you sent an article, Mark, to me earlier this week, the first ever luxury condo property. You can invest in it using Bitcoin. Can you, or I believe it was Bitcoin, can you just tell me a little bit more about that, and then maybe you guys can also comment on future sort of tokenized assets, whether it's art, whether it's revenue streams being monetized or blockchained. Talk about some of those. Start with you, Mark.
Well, I mean, I think, if you have a token backed by something tangible, it's great. And I think with real estate, obviously the traditional way, it's really a pain in the butt from a private equity standpoint or so forth. So that fractional, you're able to do that. So and I don't know if that's actually the first one, but it's a good one. And so I think that's where a token is a little bit more real instead of a token for an influencer token.
Any other tokenized asset sort of future ideas that exist now that people wouldn't think of that are interesting to you?
Yeah, I don't want to sound like Pomp. I don't know how many of you know Pomp, but he's a Twitter guy, and he talks about like tokenizing the world. But I do see a world where we can give, we can fractionalize assets in a more efficient way, so that more people around the world can have more investment opportunities. Like in Africa, there's very little that people they can't access stock markets. They can't really access real estate unless they have a lot of money. I mean, there's like very little, title. The government can take things away. So if you're able, and that's why, frankly, Bitcoin and crypto has captured the imagination of so many people in emerging markets in Asia and in these fast-growing economies, because their ability to invest their new capital is severely limited. And so I see being able to tokenize real-world assets as well as digital assets down the road. But I go back to kind of our investment thesis over the next couple of years, is we have to reduce the friction points to allow us to actually get to that point.
Yeah, tokenization will happen where there's a broken problem, or there's something that's not working well. So credit products and financial services are notoriously long to settle. We've talked about real estate up here. We've talked about private equity funds, which we were the first to tokenize. And I think we'll actually see the category of security tokens be quite large, just because the large illiquid asset classes, now that they can be fractionalized and tokenized, they will be done. The technology's already been unleashed on the world, and it solves a real problem. There's no reason why only Blackstone can own this building. If it can be fractionalized and tokenized, and a smart contract disperses the pro rata portion of the rent that your token represents, that is an exciting, novel use case of blockchain technology or tokenization technology. I think it'll be the regulatory environment that guides how fast that happens, but it will happen. Where I don't see it happening is where things work pretty well, like common stock in the stock market. I don't see a need for tokenizing common stock in Apple. Half the room in here has probably bought or sold Apple at one point, so you don't need a token for that. So I'm, unlike Pomp, we're constructive on certain subsectors, if you will, or use cases that enable something new that hasn't been done before or alleviates a acute pain point. If it works pretty well, like trading stock on Robinhood or E-Trade, it probably doesn't need to be tokenized.
I think what could be really interesting in terms of use of tokens is in terms of realigning incentives. So we heard a lot about bike sharing companies, for example, coming out of China and then expanding into the US and going into Europe. What's really interesting is actually on my last trip, I was catching up with a couple of friends who are co-founders in one of the largest, well, there's two large bike sharing companies in China. One of them is working on a prototype that's basically designing a game within the app to say, well, previously they had really expensive operational costs in terms of constantly having to move bikes from one location to another. So for example, a really good example here in San Francisco is that people always leave their bikes at the bottom of the hill and nobody bikes all the way up the hill. And so they pay a lot of money to get people to constantly move these bikes and just shift it up the hill, right? So what they're prototyping on is essentially to say, well, this is a game challenge. If you're able to ride your bike from the bottom of the hill all the way up to the top of the hill, you get rewarded in points or tokens, which then you can then use for free rides of the bike at a later point in time. And so that's one of the ways in which you can realign incentives that's actually saving operational costs for the company. So I think it's really in examples like that where you can find a clever way to design the system to realign incentives that's most interesting.
Okay, and with that, let's give our panel a nice round of applause.